Nearly every online retirement expert repeats the same message about Social Security. Hold off until 70. Capture the 8% yearly delayed credit. Get the biggest possible monthly payment. And whatever happens, never ever claim at 62 because people say you could lose $246,000 in lifetime benefits. That is the usual advice. That is the standard retirement planning playbook. But for a very large number of American retirees, that playbook can be mathematically incomplete and strategically harmful. In this video, I am going to show you 7 specific situations where claiming at age 62 is not automatically a bad move, but may be the most effective financial choice a retiree can make. And here is why this video is different from many other Social Security videos on YouTube. A lot of those videos are created by financial advisors who are paid to manage retirement investments. That business model may give them a reason to prefer strategies where you spend other assets while delaying your Social Security check. I do not manage investment portfolios. I work with retirees from the tax side. And what I see every single week in my practice is very different from the simple wait until 70 message. Retirees who delay Social Security to 70 in the wrong situation can end up paying tens of thousands more in lifetime federal taxes, getting pushed into Medicare premium surcharges they did not expect, and missing the largest Roth conversion window they may ever have. Retirees who claim at 62 in the right situation may use the early benefit to support tax planning moves that can legally save $200,000 or more in lifetime taxes, depending on the facts. That is not just theory. That is what the numbers can show when you model a real household carefully. Reason number 1 may surprise you, because very few financial advisors discuss it in detail on YouTube. Reason number 2 applies to retirees who lost their jobs or left work in their early 60s. Reason number 3 is the family health history factor every retiree should calculate. Reason number 4 applies to married couples where one spouse earned far more than the other. Reason number 5 matters for retirees with minor or disabled children still living at home. Reason number 6 applies to divorced retirees, and many people watching may qualify without realizing it. And reason number 7 is something every retiree under 65 should understand, because it relates to what may happen to Social Security around 2034. My name is Wasim. I am an enrolled agent, federally authorized to represent taxpayers before the Internal Revenue Service, and I work every week with retired clients on tax decisions connected to when they claim Social Security. Before I get into the 7 reasons, I want to tell you about a couple I worked with last year, because their case is a clear example of why the wait until 70 rule does not fit everyone. Once you understand their numbers, you will understand why standard advice can miss the bigger picture. Robert and Joan are both 62 years old. Robert worked 34 years as a mechanical engineer for a manufacturing company in Indiana. Joan worked 28 years as a hospital administrator. They both retired at 62. Together, they had a healthy traditional individual retirement account balance of $950,000. They had no pension. They owned a paid-off home worth $320,000. And when they came to me, 2 different financial advisors had already told them to wait until age 70 before claiming Social Security. Both advisors gave the same basic explanation. If they waited until 70, their combined monthly Social Security benefit would rise from about $3,700 at age 62 to about $6,500 at age 70. Across a long retirement, that delayed credit could add more than $240,000 in lifetime benefits. Here is what those advisors had not fully modeled. From age 62 through age 73, when required minimum distributions begin under current law, Robert and Joan had an 11-year period when their taxable income could be lower than at almost any other time in their lives. They had no W-2 wages. They had no pension income. They would have only the Social Security they chose to claim, plus whatever they voluntarily withdrew from their traditional individual retirement account. If they delayed Social Security until 70 and lived mainly on individual retirement account withdrawals from 62 to 70, they could spend down $300,000 to $400,000 of retirement account principal during their lowest tax years. Then, at age 73, required minimum distributions would begin on a still significant traditional account balance, and that income combined with larger delayed Social Security checks could push them into higher tax brackets for many years. It could also trigger Medicare premium surcharges through the income-related monthly adjustment amount, known as IRMAA, potentially costing them several $1,000s more per year. The alternative I showed them looked very different. Claim Social Security at age 62. Use the early checks to pay most of their regular living costs. Then, instead of relying heavily on traditional individual retirement account withdrawals as ordinary income, convert traditional individual retirement account dollars into Roth individual retirement account dollars year by year, intentionally filling lower federal tax brackets from age 62 to 73. Pay tax now at relatively low rates on money that might otherwise be taxed later at 22%, 24%, or higher once required minimum distributions start. Reduce future required minimum distributions. Reduce future taxes on Social Security. Lower the risk of future IRMAA surcharges and leave their family Roth individual retirement account assets that can grow tax-free and may pass to heirs with better tax treatment. When we modeled the numbers through age 90, the claim at 62 plus Roth conversion plan showed roughly $220,000 in lifetime federal tax savings for Robert and Joan, compared with the wait until 70 plan, even after accounting for the smaller monthly Social Security benefit. That tax savings was large enough to challenge the supposed $240,000 benefit increase from delaying. And that was before considering the possibility that one spouse could die in their 70s, which could shrink the Roth conversion window and leave the surviving spouse facing higher single-filer tax brackets. This is the story many Social Security YouTube videos do not tell, because you have to understand both the federal tax code and the Social Security rules. So, with Robert and Joan in mind, let me walk you through the 7 specific reasons every retiree should at least consider claiming at 62. Reason number 1 is the Roth Conversion Runway. I am starting here because this may be the biggest tax planning opportunity many retirees are missing right now. It is also the reason that often gets ignored in simple Social Security discussions. The federal tax code can reward retirees who keep taxable income low for several consecutive years. The years between leaving work and required minimum distributions at 73 can be the lowest taxable income years of your adult life. If you can fund those years from a source that is partially or mostly tax-favored, you may create a major opportunity to convert traditional individual retirement account dollars to Roth dollars while staying inside lower federal brackets. Instead of paying 22% or more later when required minimum distributions force the money out, you may be able to pay lower tax now by planning carefully. Claiming Social Security at 62 can help create that lower tax funding source. You live on Social Security plus a reasonable amount of taxable individual retirement account distributions. You convert other traditional individual retirement account dollars year by year. You reduce the future tax burden. You build a Roth account that can grow tax-free and may be passed to your children with favorable tax treatment. For a couple with a traditional individual retirement account balance above $500,000, this strategy can sometimes save more in lifetime federal taxes than the delayed filing credit adds in Social Security benefits. Not always, but often enough that it must be modeled. And many people never hear about it because the runway window is mainly a tax planning concept. Reason number 2, you are already retired and spending down your retirement account. This is the situation that affects many retirees who were laid off, downsized, pushed out, or simply burned out in their early 60s. The standard advice says to live from savings, draw from retirement accounts, and delay Social Security until 70. In many cases, that can backfire. Every dollar you withdraw from a traditional individual retirement account between 62 and 70 is generally taxable as ordinary income. Every dollar you receive from Social Security during those same years may be only partially taxable, often up to 85% depending on your other income. Social Security benefits also are not subject to FICA payroll taxes. If you are already draining your individual retirement account, you may be paying tax on every withdrawal at ordinary income rates while also giving up the cash flow from Social Security checks that could have reduced those withdrawals. The better move in many cases may be to claim Social Security at 62. Lower your individual retirement account withdrawals by the amount your Social Security check covers and allow more of your retirement account to stay invested for as long as possible. The compounding on the portion you do not spend can sometimes outweigh the extra benefit you would have received by waiting. Reason number 3, Your family history suggests shorter longevity. This is the reason even mainstream financial advisors may mention, although they do not always run the detailed numbers. Social Security is essentially a lifetime income benefit. The longer you live, the more total dollars you may receive. The shorter you live, the fewer total dollars you may collect. The break-even point between claiming at 62 and claiming at 70 for someone born in 1960 or later is often around age 80 to 82, depending on assumptions about cost of living adjustments, taxes, and inflation. If you live well past that age, waiting until 70 may win on total dollars collected. If you pass away before that point, claiming at 62 may win. And here is what many people overlook. Actuarial averages are just averages. Some retirees have health conditions, occupational history, or family patterns that point to shorter life expectancy. If your father died in his 70s, your grandfather died in his 60s, and your siblings are not living into their 80s, then the longevity calculation may strongly favor claiming earlier. That does not mean you should ignore health improvements or survivor benefits, but it does mean the math should be personalized instead of based on a generic rule. Reason number 4, you are married and your spouse earned much less over their career. Social Security includes a feature called the spousal benefit. If your spouse earned far less than you, stayed home with children, or worked part-time for much of their career, their own Social Security retirement benefit at full retirement age may be less than half of yours. Under federal rules, a lower-earning spouse may qualify for a spousal benefit of up to 50% of the higher earner's primary insurance amount at full retirement age. But the lower-earning spouse generally cannot receive a spousal benefit until the higher-earning spouse has filed for their own benefit. If you wait until 70 to file, your spouse may have to wait as well. For couples where one spouse earned much more than the other, filing the higher earner earlier can unlock several years of spousal benefits for the lower-earning spouse. During the years between 62 and 70, those additional spousal payments may total $70,000 to $150,000 in some households, and that can offset much of the reduction caused by claiming early. The exact answer depends on ages, earnings records, survivor benefit planning, taxes, and health, but this is a major reason married couples should not analyze one benefit in isolation. Reason number 5, you have minor or disabled children still at home. This is one of the most overlooked rules in the Social Security system, and it matters for retirees who had children later in life, are raising grandchildren in qualifying situations, or have an adult child who became disabled before age 22. When you claim Social Security retirement benefits, an eligible child may qualify for a dependent benefit. This can apply to a child under age 18, a child up to age 19 if still in high school, or a child of any age who became disabled before 22 and meets the rules. The child's benefit may be up to 50% of your primary insurance amount, subject to the family maximum. That family maximum is commonly around 150% to 180% of the worker's full benefit amount, depending on the specific calculation. For a retiree with 2 eligible children at home, that family maximum can create meaningful extra household income every year until the children age out or no longer qualify. If you delay Social Security until 70, you may give up every year of those dependent benefits during the gap period. In some families, that lost benefit opportunity can add up to well over $100,000. Reason number 6, you are divorced, your ex-spouse was a higher earner, and the marriage lasted at least 10 years. Many divorced retirees do not know this rule exists. Under federal law, if you were married for at least 10 years, are currently unmarried, and meet the age and eligibility requirements, you may be able to claim a divorced spouse Social Security benefit based on your former spouse's earnings record. The maximum divorced spouse benefit can be up to 50% of your ex-spouse's primary insurance amount at full retirement age. Your claim does not reduce your ex-spouse's benefit. It does not reduce the benefit of their current spouse. It does not require your ex-spouse's permission. In many cases, they do not even need to be involved in the process. The Social Security Administration determines whether you qualify and pays the benefit under its rules. For divorced retirees whose former spouse earned significantly more than they did, the divorced spouse benefit may be higher than their own retirement benefit. Filing earlier instead of waiting may provide tens of thousands of dollars in income that would otherwise be delayed or missed. If you are divorced, were married for 10 years or longer, and have not remarried, it is worth contacting the Social Security Administration and asking whether you may qualify. Reason number 7, Social Security's trust fund projections matter. This is something every retiree under 65 should understand, because the numbers come from official trustee projections, not internet rumors. Recent Social Security trustees' reports have projected that the retirement trust fund may be depleted in the early 2030s, with the combined trust funds projected around 2034 unless Congress acts. If lawmakers do not make changes before depletion, incoming payroll tax revenue would still fund benefits, but not necessarily 100% of scheduled benefits. Trustee projections have indicated that payable benefits could be reduced to roughly the high 70% range of scheduled benefits. In plain English, that means there is a possible future shortfall unless Congress changes taxes, benefits, or funding rules. For someone expecting $30,000 per year in Social Security, a significant across-the-board reduction would be financially painful. No one can predict exactly what Congress will do. Lawmakers may act before any automatic reduction happens. They may change taxes, benefits, retirement ages, or formulas, but there is no absolute guarantee about timing or outcome. Because of that uncertainty, some retirees place value on receiving checks earlier rather than delaying everything into a future policy environment that could change. Every monthly payment received before any future reform is money already collected under current rules. Now, before I close, there is one bonus situation that is the shadow side of the 7 reasons I just covered, and it is the trap that catches retirees who follow the wait until 70 advice without seeing the full picture. I call it the tax torpedo, and it can become one of the most expensive retirement mistakes people face in their 70s. Here is how the tax torpedo works. If you wait until 70 to claim Social Security, your monthly benefit can be about 76% larger than it would have been at 62 for people with a full retirement age of 67. That sounds attractive. But 3 years later, at age 73, required minimum distributions begin on most traditional retirement accounts. The combination of a larger delayed Social Security check plus required minimum distributions from a still large traditional individual retirement account can push you into a higher marginal tax bracket, make up to 85% of Social Security taxable, and trigger IRMAA Medicare premium surcharges that may cost thousands of dollars per year. The retirees most exposed to the tax torpedo are often the same retirees who followed generic advice, delayed Social Security until 70, and never converted traditional individual retirement account dollars to Roth during their low tax years. They reach their 70s and find themselves facing a tax cliff that is difficult to reverse. Claiming at 62 and using the gap years for Roth conversions can be one practical way to reduce or avoid that tax torpedo. This is why these 7 reasons matter. This is why the standard advice can be wrong for many retirees. And this is why I want every retiree watching this video to run the actual numbers, including the tax planning numbers, before making a permanent decision to wait until 70. To help you do that, my team and I created a free resource called the 2026 Retiree Protection Checklist. It is a 42-page comprehensive guide covering the Social Security claiming decision tree we just walked through, the 4 most important Roth conversion timing windows, the 9 Social Security and Medicare timing decisions retirees commonly get wrong, the IRMAA A-tier brackets and ways to manage them, the 7 commonly missed deductions for retirees, and a complete protocol for helping protect retirement accounts from federal reporting problems and elder financial fraud. It is completely free. It is not a teaser. It is not a sales pitch. To have the checklist sent directly to you, go to securefuturehub.kit.com/checklist. Enter your email, and the full checklist should arrive in your inbox within a few minutes. And while we are talking about taking control of your retirement finances, if you are a retiree who handles your own tax return, I want you to look at TaxLayer. TaxLayer is the software I personally recommend to clients who are comfortable filing on their own. It is often much less expensive than the larger competitors you already know. It handles many situations retirees commonly face, including Social Security income, pension distributions, required minimum distributions, capital gains, and newer 1099-K reporting requirements. It is also backed by tax professionals you can contact if you get stuck. The link is in the description below this video, and using that link helps support this channel at no extra cost to you. Let me end with the most important point in this entire video. The decision of when to claim Social Security is one of the largest financial choices most retirees will ever make. It locks in a stream of income for life. It interacts with your tax bracket, Medicare premiums, retirement account withdrawals, spouse's benefits, survivor planning, and long-term cash flow in ways that many online calculators and many general financial advisors do not fully model. The common advice to wait until 70 is correct for some retirees. It can be very wrong for others. The only way to know which group you are in is to run the actual tax-adjusted numbers, including the Roth Conversion Runway, the Spousal Benefit Unlock, the Family Longevity Break-Even Point, and the Trust Fund Projection Risk before you decide. Claiming at 62 is not automatically a mistake. In the 7 situations I just explained, it can be a very smart financial move for the right retiree. The retirees who lose the most money are not necessarily the ones who claim at 62. They are the ones who follow generic advice without doing the math. If this video helped you, please hit the like button right now, because that is one of the strongest signals telling the YouTube algorithm to show this video to more retirees who are about to make a Social Security claiming decision and need the full picture before they commit. Subscribe if you have not already, because next week I am releasing a follow-up video on the 3 exact tax planning moves every retiree should consider in the year before claiming Social Security, whether they file at 62 or 70. And if you know a friend, sibling, parent, or neighbor between ages 60 and 70 who has not yet filed for Social Security, send this video to them directly. This decision is too important and too lasting to make based on one advisor's opinion or one YouTube video. These 7 reasons need to be part of the conversation. I will see you in the next Secure Future Hub.